Thank you, Chairman Powell, for joining us today. Inflation remains broad-based and persistent, two troubling trends the Fed expects will continue. As you said last week, the process of getting inflation back to 2% is a long way to go. So even though the Federal Open Market Committee did not recommend a rate increase at last week's meeting, it's fair to say that the Fed will continue to make additional increases in the months ahead. We'd like to hear your thinking on those matters. As the FOMC again pointed out last week, the labor market still appears tight, with Fed policymakers projecting a rise in an unemployment rate to a still low 4.1% at the end of the year. Despite pressure from the left, the Federal Reserve must remain committed to eliminating this stealth tax on American workers and families, and I urge you to continue that resolve. A few weeks ago, Congress took the first step toward getting our fiscal house in order through the Fiscal Responsibility Act. Republicans will continue fighting for sensible spending reductions to combat inflation. This stands in stark contrast to Democrats' spending spree that poured nearly $2 trillion into a supply-constrained economy that was already flush with trillions of savings provided by earlier bipartisan COVID rescue efforts. And after keeping interest rates too low for too long, the Fed was slow to address the problem. In a stunning about-face, the Fed then raised interest rates by 5 percentage points in a little over a year, the fastest spike in modern history. This approach introduced accelerated interest rate risk for which companies, workers, and families across the country were not prepared. The bank runs we saw earlier this year are an example of the consequences. Now we're told these runs represent a systemic threat to the stability of our financial system. Add in the commercial real estate exposure facing financial institutions, and it becomes very easy to understand the mounting anxiety consumers and job creators share. And I share their anxiety as well. The rapid rise in interest rates, coupled with knock-on effects of the bank failures, have led to signs of a credit crunch across the economy. This would have a damaging impact to consumers and job creators alike. To top it off, Vice Chair for Supervision Michael Barr is undergoing a so-called holistic review of capital requirements. And something interesting that he mentioned in the press even yesterday is a new approach to stress tests that I can't quite understand. If reports are accurate, he's pursuing a massive increase in capital standards for medium and large institutions. This would limit banks' ability to lend money, exacerbating the looming credit crunch and starving families and small businesses the capital they need. Financial markets will also bear this strain as they will be forced to absorb nearly $1 trillion in new treasuries. This has led many to believe the Fed may be called on to help, perhaps through its repo or other facilities. Clearly, our economy is in a precarious position, from inflation to a potential credit crunch to substantial balance sheet risks for financial institutions. There's a great deal of uncertainty on the horizon. Uncertainty from the Fed supervision and regulation is the last thing the well-capitalized banking system needs now. Following numerous supervisory failures and a new vice chair for supervision at the Federal Reserve injecting politics into policy, it's become clear that Congress may need to again examine separating supervision and regulation out of the Fed and gaining greater oversight and control by Congress in the elected branches.